Okay, good afternoon. Thanks for joining us, everybody. It's Jake Smith here from Crunch. I'm our Content Strategy Manager, and I'm very pleased to be joined by Michael Awuye, our Technical Senior Accountant for Crunch, who's going to take you through all the complicated bits. So thanks ever so much for joining our webinar today. We're going to cover the end of the 2019-20 tax year and also the start of the 2021 tax year, just to give you some tips on the things that you need to get done and what you might want to do to get ready for the next tax year. It would be remiss of us at this point, with the unprecedented events going on around the world, not to cover some of the other recent announcements from the government. So just to say, there's a question facility within the GoToWebinar control panel. You put your questions in there. We'll try and make sure we cover them all. Whenever we've done these end of tax year webinars before, there have been a lot of questions. If I know that we're going to be covering it in a later slide, I'll hold off on asking your question. If it looks like it's relevant to where we are in the presentation, I'll interrupt Michael, but otherwise I think that's pretty much good to go. So we've already had a question from Ian, and I am about to cover exactly what you've just asked on, Ian. So just a quick introduction, because we have got a number of people who aren't yet Crunch clients. We are Crunch, so we're online accountants. We offer a full service online accountancy tool with superhero client managers and expert accountants to meet all your needs. And we also help other bits of your business, such as self-employed mortgages, small business insurance, and investments and pensions. As I said, our client managers and expert accountants are always there to answer all your questions. We do webinars regularly. We send out regular information to our clients, and we specialise in contractors, freelancers, and small businesses. If you're already a Crunch client, hopefully you know that. So I think the first thing to cover is obviously the breaking news around the COVID-19 emergency. I have someone called Timothy, saying no audio and audio option disabled. We've checked with a number of other people who said that they can hear us at the moment, so I do apologise if you're having any problems. You might want to try dialing in. We'll just carry on with the presentation and hope that you can get it sorted. So breaking news around government and the COVID-19 emergency. Obviously, this is an ever-changing situation at the moment. It's pretty unprecedented, I think, in most of our lifetimes, what's been going on. The government initially announced some measures in the budget, which was only on the 11th of March, my son's birthday, and even by the 16th of March, they had felt the need to announce hugely upgraded measures. There's a £330 billion package of support for businesses. That support is through various means. There are government-backed loans, there are cash grants to smaller businesses, there are business rates holidays, and there are a number of other measures targeted at retail, leisure and hospitality sectors. As we said, the support's about £330 billion is what they've announced. We are expecting additional measures to support jobs and incomes in the coming days. There hasn't been a huge amount announced for self-employed yet, it has to be said. We have just published an article on our website for coronavirus support in the knowledge section of our website. We're going to use that for sort of all of the breaking news as we go through. We're not going to cover the announcements in there for the self-employed on today's thing, but we will make sure that we keep you updated on everything. In terms of Crunch, just a brief update, we are a cloud business, so we are able to work either from our offices or from home, and we've been practicing that successfully over the last few days. So we're confident that we're going to be able to continue to support all our businesses with no interruption to our service. The only thing I'd say on this is, please everyone, try and keep yourself safe. It's at times like this, we need to look after each other. So the other breaking news that is definitely not more important than COVID-19, but if you run a small business, you would probably have had to have been hidden under a rock for the last year if you hadn't heard about IR35 changes. And last night,
the
Treasury Minister announced in Parliament that the IR35 changes were going to be deferred for 12 months until April 2021. I think it's important to say that this is a deferral. They did not announce any changes to the rules that they intend to bring in, but obviously the major change that we have another 12 months to prepare. We've got just a couple of points on this slide, just to say the public sector arrangements remain as is. They were introduced in April 2017. They've announced no changes to those. So what this means is that personal service companies will continue to be responsible for assessing their own employment status for each and every assignment and for paying any employment taxes that are deemed due. The end client will not now be taking over responsibility for that assignment for most of the private sector things, which means that, as far as we're aware, there will be no need for a status determination statement to be produced by end clients. As I said before, the government are very clear that this is only a deferral due to the extraordinary challenges facing the country and the economy from the COVID pandemic. Our advice as accountants at Crunch, we're going to come on to this in a slide later in the thing, has always been to try and keep your limited company trading, and this remains our advice. Obviously, this is probably very beneficial for a lot of contractors at the moment. If you have recently changed or been told to change your working arrangements to an umbrella or to PAYE by your end client, then you may wish to speak to them to see whether that is still going to be necessary. Obviously, it is usually more tax efficient to work through your limited company. However, you do need to make sure that you are paying attention to IR35 still. The deferral of the introduction of the new rules does not change the existing rules of IR35. So if your assignment is deemed to be inside IR35, you should still be paying employment taxes, whether your business needs to pay them or whether the end client needs to pay them. And our IR35 calculator that you can get to on the website and use for free as a contractor will tell you very clearly whether your assignment is inside or outside IR35. And remember, each assignment needs to be assessed on its own merits. Crunch obviously have always adapted our products and services to suit the market, and our services and products are fully flexible. Our Plus product lets you work inside or outside IR35 or through an umbrella company. So do speak to us with any individual questions you've got about IR35. So with that, I'll hand over to Michael to take us through the main section of the presentation.
Okay, thanks, Jake. Okay, for 2019-2020 tax year end, obviously there are a few things we need to be doing. So we start off with the basics, which is to do with dividends and salary. For those not taking the recommended salary, it's 8,632. And then you take dividends of 41,368. Now, both figures combined takes you up to the 50K threshold for basic rate tax. Now, if you take above this, you would obviously be paying tax at the higher tax rate, which is 40% for income tax and 32.5% for dividend. Now, in terms of the recommended salary of 8,632, that also qualifies you for state pension entitlements. Now, to qualify for the full state pension, you need to pay the recommended salary for up to 35 years. That's what qualifies you to a full state pension. If you pay only for, let's say, between 10 and 35 years, you'd only get a proportion of state pension entitlement. So please note that if you're taking a recommended salary, it qualifies as a full year towards your state pension entitlement. For those having any other income, such as rental or probably sole trade income, you might want to speak to an accountant to find out how much salary should be taken. Because if you take the recommended salary plus your rental income and the rest, that basically means that you'll be paying tax at a higher tax bracket. So please speak to an accountant for that. Please also be minded of payments on accounts. The 2,662.50 here, it's your tax bill for the year. But obviously, with payments on account, it simply means you're paying next year's tax bill in advance. So since you're talking about 1920, you'll be paying the same amount times 2 for the 2021 tax year. And that simply means that when you get to file your self-assessment for 2021, they will then, let's say, reduce your tax bill by the amount you've paid in advance. So for those who don't know about payments on account, it's simply for those payments in advance towards your next tax year's bill. For the payments and accounts as well, you only have to make this payment if your tax bill is more than £1,000. So if your tax bill is less than 1,000, you don't have to worry about that payment and account. Okay. Next slide, please. Yes, in terms of the dividend amounts recommended for the 41,368, this amount is made up of your unutilized personal allowance. Now, the personal allowance for 1920 tax year is 12,500, but obviously we've recommended that you take a salary of 8,632. This 8,632 is pegged to the NI threshold. So what this simply means is that if you take more than the 8,632, you'll be paying national insurance contribution. Now, this amount still means that you've got 3,868 of personal allowance unutilized, and that is what you can then claim in extra dividends. There is also the £2,000 dividend allowance, which hasn't changed from the previous year, and you then have the remainder, which is 35,500 being taxed at a 7.5 rate. So all three combined takes you up to the 41,368. If you take above this, you would then fall into the higher tax bracket and then be taxed at 32.5%. Now, it's also good to note that those in Scotland, although they have different income tax rates, if they were to take the same salary or the recommended salary, they would pay the same tax as the rest of the UK.
Okay. We just had one question on the salary from someone who had actually set their salary at 8,630, so obviously £2 off what they could have paid. Would it, in that instance, would it be sensible to adjust your salary up to the maximum?
£2. If you lose it out on, let's say, the £2, you can still take more dividends.
Yeah.
Anyway, so
depending on whether your final payment submission has been filed already or not, I wouldn't worry about it too much.
If you're a crunch client and they can easily get it done, then that's fine. If not a crunch client, then they could take dividends to compensate for it.
Yeah. So because the tax threshold of 50,000 is when you might start paying basic rate, this means that you've given yourself a little bit more that you could take in dividend rather than a salary.
Okay, thank you, Michael. Yes, we've done this one. Okay, so taking salary, obviously we know is tax efficient because it's tax deductible. So that means that when your limited company is basically filing its accounts and the rest, it would reduce your corporation tax you pay and the rest. But taking salary also comes with obligations for the limited company. There's what we call Rti Submissions, which is a monthly submission done to HMRC to notify them that, let's say, these employees have been paid X amount, and then we've deducted the following, and HMRC then knows how much your tax bill is and the rest. That is on a monthly basis. But then we also have something we call the full payment submissions, which is meant to be done at the year end. Otherwise, there's a £100 fine. Now, there are four categories of people or clients I've grouped here. We've got crunch clients who are already on the crunch payroll. That means that we've actually been doing the payroll for them internally, or our crunch payroll team have been working on theirs. They don't need to do anything because obviously we will do the submission for them. There are those who are having recurring payroll of the 719 on a monthly basis. With this group as well, it will be done. You simply need to go and then obviously take to file your final submission, and then that will be done. Then there are the two groups who are either taking below the recommended salary, which is the 719 a month, or not taking anything at all. Now, with these two groups, if you want to be tax efficient, then it will be recommended you bump up your salary to the 8632, and then you file your FPS after. So that is for those two groups. Those who have any extra income from, let's say, rental or sole trade, again, it will be best to speak to an accountant to pick their brains on how much salary should be taken before filing your FPS. Okay?
So just one question on that. There's been a few questions around dividend allowances and how they're affected by additional income, either whether that is PAYE income or income from rental.
Yes.
So is there a simple answer that you can give to how that rental income or PAYE salaried income would affect your dividend allowance?
Yes. In terms of income tax, salary, let's just say if you were trying to arrange them in order of hierarchy, salary would obviously come first. Okay. So if they had any, let's say, sole trade profits as well, that would then mean that the amount they can take for dividends also reduces, because all of those things would fall into the basic rate tax threshold first. I think the wording that they use is top slicing approach anyway. So depending on the type of income it is, it might, let's say, take precedence over dividend. So that's why it's best to speak to an accountant to obviously work out what income they've got, be it maybe salary from another employment, sole trade, rental, capital gains tax, and the rest, so that we then know whether they should take more or less dividends.
Yeah.
Without knowing the exact income they've got, it's going to be a bit difficult to advise.
Yeah.
Yeah.
Okay. So if you're a crunch client and you have any questions about other sources of income and how that affects you, then speak to your client managers or send us in a question via your support at crunch.co.uk, and we'll get back to you. Okay.
Yes. Expenses. Now, in most cases, expenses are usually accounted for whilst doing your company account, because the company would obviously have a bank account, and anything that basically goes through it is usually picked up by an accountant who prepares your accounts to the year-end date. What is, however, missed is what is paid outside of the company. So this usually would be things that directors would pay for personally out of their personal bank account. For instance, let's just say if they had use of home, I mean, working from home and the rest, most people will be paying for it through their own personal bank account, and then should be making a claim to the company for using their home as, let's say, a business premises and the rest. Things like mileage, if you're using your personal vehicle for work and the rest, you should be claiming mileage and the rest. But all of these things are usually paid out of the director's personal pocket. So it's essential you basically have these things being put through your company accounts before the year-end because if you don't claim it, it then means that you end up paying more tax than you would actually be expected to. But in theory, all those who usually reconcile, or those who've been usually crunch clients for a bit, would have gotten used to being reminded by accountants to actually claim these expenses. On the issue of records and then receipts, you obviously have to keep them 6 years after your company year end. You don't need to actually have them in boxes and folders anymore. I mean, you could have them on, let's say, hard drives and the rest. It can be kept electronically, and that's basically acceptable. With the crunch up as well, you could obviously take images of your receipt and the rest, and then that basically then means that it's been stored for you. So these are some of the things that we should be doing to actually make sure we're actually claiming all the expenses we can. Okay. Now, in terms of tax breaks, we've got ISAs and pensions, and pension is basically the biggest one. This is actually for those who've got a bit of spare cash lying around anyway. Pension allowance is basically 40,000 a year. For those who haven't paid into a pension pot for the previous 3 years, you could actually, if you've got the funds, if you've got about 120,000, you could pay into it and then basically utilize that against your previous tax years where you haven't paid into a pension pot. But obviously, you need to speak to an accountant as well to make sure that you are being tax efficient. Some may have paid, let's say, maybe 10,000 the previous year. So that means that if you paid more than the 40,000, you can only utilize maybe 30,000 towards the previous year to bring it up to the 40. So this is something that you probably need a bit more specialist advice on anyway, and our accountants are there to help. Okay, we're going on to 2021, and pretty sure most of you are aware it's become a bit more interesting and let's say complicated over the last couple of weeks. We were expecting to have the rate changes earlier on in January, but then it was delayed until March, and we just keep having more and more information popping out every now and then. So bear with us with this one, because it seems like things are just changing every day. In terms of personal allowances and then the basic rate thresholds, these haven't changed, so nothing new on that front. What we basically got is the NI changes. Now, to keep in line with the promise they made during the campaign and the rest, they've decided to increase the NI threshold, which basically makes sense because it puts more money in people's pockets anyway. But the interesting thing is that they basically split the primary threshold and then the secondary threshold. This is something they haven't done since 2016-2017 tax year. Now, for those who are not aware, the primary threshold is where an employee pays national insurance contributions. So if, in this case, if you earn more than, let's say, 9,500 as an employee, you would then be subject to national insurance contribution at 12%. The secondary threshold is where the employer pays national insurance contribution at 13.8%. So taking these two numbers, for example, if an employee was being paid 9,500, the employer or the company wouldn't deduct any national insurance contribution from their pay packet. But the employer would have to pay a national insurance contribution on the difference between the 9,500 and then the 8,788, and they would have to pay the NI at 13.8% on the difference between these two amounts. That usually brings it to around, I think, just below £100. I think it was around £98 or so when we estimated it. And this is what we basically need to be a bit worried about. So, having had the primary threshold and then the NI, the secondary threshold, we're trying to work out what was efficient for our clients anyway. And we had to do a bit of a cost-benefit analysis, and we settled on the 8,788 being tax efficient. We did consider factors such as employment allowance and all of that, but the extra or tax you have to pay, or the extra national insurance contribution that you have to pay in terms of taking a salary of 9,500 wasn't really worth it when you could easily compensate with that of dividends. So we settled on the 8,788. In terms of the employment allowance, this has been increased 4,000 now for the 2021 tax year. It was 3,000 for 1920, but it's been bumped up by 1,000, obviously to help businesses out as well as part of coronavirus and other issues going on. Those entitled to this £4,000 allowance are those whose employer's NI bill is less than £100,000, and we've got a good article for you to read when you've got a bit of time.
Yeah, we'll definitely make sure that these slides are sent out to people afterwards. The slides will have links in. All of the links are to our knowledge articles, where you can find everything. We've kept everything up to date on there.
Okay. Dividends, as we've already mentioned, there wasn't really a change in the basic rate threshold. So we are still taken up to the 50,000, and the tax-free allowance is still the £2,000. So it's still the same. I mean, the tax bill is still the same for 1920 as it is for 2021. The only difference is that because of the change in NI threshold and the recommended salary, salary is now the 8,788, and then the dividend is slightly less, which is 41,212, but the tax bill is still the same. So it's just switching numbers around anyway. Obviously, you still need to account for payments and accounts, which you've already explained, and Scottish clients don't need to worry if they take the recommended salary. They've changed the first three bands for Scottish taxpayers, but then once you're taking a recommended salary, you'll still be paying the same tax as the rest of UK.
Okay.
Now, before yesterday's announcement, and this was what we originally had lined up for you in terms of R35. Now, the government finished the consultation in February, and then they basically gave a few pointers as to what they were going to do in terms of R35 if it was to start from the 6th of April 2020. But obviously, there's been a deferral. But what the government basically outlined then was that the new rules were obviously going to apply to the medium and large size businesses. Now, medium and large, for those who've seen our article, turnover of 10.2 million, balance sheets total of 5.1 million, and then 50 or so employees. Those were the three criteria. And that was the rule. So the end client obviously was going to obviously do a status determination for the worker, or let's say in this case that'll be your personal service company, and then they will then start doing the deductions. But with a deferral now, this means that all of these things are being postponed till next year. Now, in terms of the status determination, obviously, with that being out of the window now, what that means is that for R35, you as a director of a limited company will still need to decide whether your company falls within, or the work you're doing, the engagement falls within R35 or not. So the deferral only applies to medium size clients, medium and large size clients, in terms of taking the responsibility away from them in terms of determining whether a contract falls within R35 or not. That, however, doesn't mean that R35 disappears altogether. The public sector is still having the R35 rules that have been in place since 2017. And for the private sector, it will be down to the limited company to decide whether the engagement or the contract they are in falls within R35. So please be mindful of this. You can also see our website for lots of helpful tools and calculators we've got there for you.
Yeah, so just to reiterate on that, although it's been put off for 12 months, the rules do still apply.
Yes.
The only thing that's been put off is whether your limited company has to apply the rules or whether your end client applies the rules. So HMRC could still come after you for unpaid employment taxes if they deem that you are inside R35.
Yes.
So our R35 tool is free to get your basic result.
Yeah. Yeah. Now, there was an interesting one to do with overseas clients. Now, when HMRC or the government talked about introducing R35 to the private sector and the rest, in the Finance Act 2017, it did state that those with overseas clients will still be treated, assuming the overseas clients were UK residents. So let's just say if you had limited an end client who was, let's say, based in the US, they would still be expected to apply the R35 rules in terms of determining your status, whether you fall within R35 or not. Now, this was a bit of a hard sell because you couldn't actually expect a foreign company who hasn't got any need to apply UK rules to be abiding by this. And in the consultation, HMRC basically realized that it wasn't really feasible. So they were planning on making an exception for those who have overseas clients but no UK body or UK agency. So if, for instance, a US company directly contracts, let's say, your limited company, then they will be exempt in terms of having to apply the R35 rules. However, if the US company had, let's say, an agency in the UK, then HMRC was still looking at having the UK agency abiding by those rules. And that was the whole plan anyway. But I guess this has all been postponed or going to be postponed until next year. They also intended to actually be lenient in the first couple of months or 12 months in terms of the penalties and the fines and the rest, except in cases of deliberate non-compliance. That was only bits where they wouldn't have been a bit lenient. For services as well, we had a few clients who were a bit worried about works they had done prior to the 6th of April and then payments being received after being subject to R35 rules. But then HMRC did clarify that it would only apply to services carried after. And then also a requirement on the end client to provide an indication of the size of the organization when asked by the agency or the worker, and that they were going to put into legislation. But obviously, these have all been deferred to April 2021.
Okay.
Now, the government has also made a few changes in terms of benefits in kind for company cars. They've changed the rates. So from 3,430. It's been increased to 3,490 for company cars. Fuel has basically gone up to 666. Yeah, but all of these obviously have a bearing on the amount of benefits in kind as well. And please also bear in mind that the benefits in kind obviously also affect your tax payments as well, because we've been telling you about the 2,662.50 tax bill and the rest. Having benefits in kind and the rest also does bump this up. So need to bear that one also in mind. For student loans as well, they've changed the thresholds now. So they've increased it to 19,390 for those on Plan 1, and then 26,575 for those on Plan 2. The deduction rate is still the same at 9%. For postgraduate loans, they haven't made any changes towards, I guess, because it's recently just come through, so it wouldn't be wise to probably bump this one up. But please note that the rules for England and Wales are different from that of Northern Ireland and Scotland, who pay 9% above 18,330, and for England and Wales is 6% above 21,000.
Rather than a question that's just come in, actually, we just had a handy tip going back to the company cars or vans thing. Just to point out, thanks Paul Greenwood, we have actually put this in our company car article, but there is a 0% benefit in kind rate for electric vehicles in 2020-21. So it is more beneficial to have an ultra low or zero emission car, and there are sort of thresholds depending on how far for hybrid cars.
The range of travel.
Up if your hybrid car can go over 130 miles. On just electric, then it's 0%, but I don't believe any can actually do that yet. And then
the technology is still improving anyway, so
it's definitely the government have definitely moved to try and make green cars better this year, so that's positive.
Yes, other changes you might probably need to be aware of is obviously minimum wage has been increased. But lifetime allowance for pensions, it was originally, I think, 10 million. No, sorry.
$1,050,000.
Yes, $1,050,000 has been changed to 1.73. But for entrepreneurs relief, they reduced the lifetime allowance from 10 million down to 1 million. And this is going to affect lots of clients who are looking to close down their companies, because depending on how much you've already claimed in terms of entrepreneurs relief as well, this might obviously have a negative impact. But not sure how many clients would have this level of capital in their businesses. But speak to an accountant. We have a dedicated team, Prometheus. They usually deal with closing clients and then can give you all the up-to-date knowledge you need on this. Capital gains tax annual exemption has been increased by £300 to 12,000, and the annual investment allowance, the government introduced the 1 million allowance for 2 years, which was a temporary measure that obviously ends 31st of January. 31st of December this year. It ends on the 31st of January 31st of December this year. So that's when the 1 million allowance ends, and it would go back to 200,000 from the 1st of January 2021. There's also the VAT reverse charge in the construction industry. It was supposed to have come through last year, 1st of October last year. But that was postponed for a year. Now, with the issues we've got around coronavirus and the rest, and with IFI being delayed, who knows where we'll be around October time. So fingers crossed, they might delay it again. Who knows? But
it's certainly very complex, isn't it?
Yes.
Okay. So, thank you, Michael. That's a whistle-stop tour through most of the changes, the things that you need to get ready for the end of the 1920 tax year, and the things that we think you should know about for the 2021 tax year. We have had a load of questions come in. We've got some recommended reading at the end of this article. There might be some things that need to be updated. Obviously, the IR35 announcement was only made at about 7:20 last night.
Yeah.
So our articles don't necessarily yet reflect that, but most of the other numbers should all be in the articles that we've got there. We'll make sure that the slides do get out to people along with a recording of this webinar. I'm just looking through some of the questions that have come in. There's a few questions about people who are just starting out and might not yet be taking a salary, when they need to register for RTI and whether they should take any salary before the end of the tax year.
I would basically say if they're just starting out, I would recommend that in order to utilize the benefit of the tax year, they register for PAYE scheme so they can take a salary. Before you can take salary, you need to be registered for PAYE.
Yeah.
That's point one. Now, if they are starting out as well, one thing we need to be a bit mindful of is the fact that they may have already been working.
Yeah.
So let's just say someone has left employment and then started their own limited company. In that case, it wouldn't be recommended to then take a salary. The point being that let's just assume that they were maybe on average, someone is on 30K, 35 a year and the rest. They would already be above, let's say, the limits of the recommended salary. So taking any more salary then means that is going to be taxed at 20%. What would be better in this case would be that they rather take dividends.
Yeah.
Now, if they were taking that first for the dividend allowance, and then also depending on how much salary they've got as well, if let's just say we take a combination of you factor in the salary they've already got from their their previous employment, and then you add on dividends. Let's just say that maybe the tax estimation comes to a lower figure than they've already had deducted by their previous employer through their PAYE, then that means that they then get a tax refund back. So I would say dividend is the way to go if you've already had some kind of employment.
Yeah.
If you haven't had any employment at all or no income, then it'll be best to probably have the PAYE scheme set up,
yeah,
and then you can then take your salary up to the recommended threshold.
So you have to be registered for PAYE if you want to pay yourself a salary.
Yes.
And you need to be registered as self-employed as well. We've got articles on all of these things. Obviously, if you're a Crunch client, we should already have done all of these things for you when you sign up with us as a limited company.
Yes, but not everyone basically wants to sign up for it because they want to do it. Maybe, as I said, they've already been times. Yeah, they are at different times. So.
Okay.
Speak to an accountant would be the best.
Yep. Okay. We had a number of questions about the NI thresholds and whether that was whether that saw people qualify for qualifying years for their pension.
Yeah.
I think we have an article in our knowledge section. How much should I take as a salary?
Yeah.
I'll probably add that into our recommended reading, but there's a number of rates, aren't there? There's another NI threshold called the lower earnings limit, which is 6240 in the 2020-21 tax year and was 6136 for the 2019 tax year. You need to pay yourself above that amount if you have no other income and you want to accrue a qualifying year to your state pension. But then usually we recommend that you don't pay above the relevant NI threshold, so that you don't need to actually pay either employee or employer. Run a little bit. We had a question about from another one starting out from a sole trader saying, if you issue an invoice now in March but it's unlikely to be paid until next month, 18th of April, should you account for this money in the 1920 or the 2021 tax year?
1920. Income is recognized when the work is done. Because there's an accounting term which is basically income recognition. So if the work is done, let's say in the 1920 tax year, then that income should be recognized in that year. It's not for the next.
It's not when it gets paid.
It's not when it gets paid.
It's when it's due.
When you recognize it in this tax year, what then happens is that when let's say your accounts are done, because the invoice hasn't been paid, there's something on your balance sheet which basically says trade debtor. And trade debtor basically recognizes all the amounts, let's say, due you for, let's say, the previous tax year or the previous company year, which hasn't been paid.
Is that the same for sole traders as for limited companies?
Same thing.
Yeah. Okay. So the simple answer is, if you've done the work in the 1920 tax year, it should be in your 1920 self-assessment and accounts.
As accountants, what we sometimes do is that when sometimes a client may have done the work for, let's say, the 1920 tax year, but would have raised the invoice for 2021, what we do is that we post what we call an accrued income journal, and then basically account for it in the correct year, and then we reverse it out in the next year. But it's not something that clients basically need to worry about
too much. Okay. So a quick question about self-assessments and payment on account. Someone says, I was PAYE for 18-19 tax year, so no self-assessment was done in 1920. But in 1920, I was self-employed. Will I need to make a payment on account?
It depends on how much their tax bill is. So first of all, if their tax bill is more than £1,000, then they will need to do a payment on account. And the payment on account will be towards the 2021 tax bill. So you first of all pay, let's just say for argument's sake, their tax bill for 1920 is 1,005. Then they will need to pay the 1,005 for 2021 is split into two. So they'll need to pay 750 plus 1,005 for January 31st of January 2021, and then also make another 750 payment in July 2021 again.
So just going back to this situation, if you only started becoming self-employed in the 1920 tax year, then your first self-assessment is not going to need to be completed until the
31st of January 2021.
So there is unlikely to be a payment on account needed before then.
No. The self-assessment account will be on that date.
And your self-assessment will tell you what you owe. We had a question, I think we covered this, but we had a question about whether rental is added to salary and not added into an overall salary and dividend total. So this is if you have additional income that is rental income.
Yes, rental is more likely to be added to income rather than dividend.
Okay. Is your dividend allowance affected by an additional PAYE salaried role?
No, the dividend allowance is basically 2,000.
That's the tax-free allowance.
The tax-free allowance, so that isn't affected by having.
And that doesn't even have to be a dividend from your own company. So it could be dividend from another company you hold shares in.
Yes, it's just a dividend allowance.
There is 2,000 allowance for your dividend. Obviously, then if you are running a limited company as well as working in PAYE, then your the amount of tax you pay is dependent on your total income, isn't it? So if
Yes.
you are all the time you're a basic rate taxpayer on your combined income, you pay dividend taxes at the basic rate. As soon as you become a higher rate taxpayer on your combined income, then your dividend tax rate for any amount above the threshold is the higher rate.
Yes.
Okay, hopefully that makes sense.
You should become an accountant.
So there was a question about how dividends work in the scenario where pension payments have been made during 1920. So if you made pension payments from your limited company, first of all, and they're classed as an expense, is that right?
Yes, from a limited company, the pension will basically be a tax deductible expense. So just like the way you have salary and the rest, it would obviously reduce that. Now, it depends on, I'm not sure in which context they are putting this question, but if you're talking about pension release, basically affecting their dividend and rest, paying into the pension means that you are given some kind of, let's say, a relief when you are computing your self-assessment and the rest. So that increases your tax band. So I guess maybe that's what the person is basically asking about.
Okay.
Not in terms of the company point of view.
Yeah. So if you're still on the line, we probably need to speak about your personal situation rather than things in general. It can get complicated.
Yeah.
Okay. In terms of if you're a crunch client and your final payment salary, so the PAYE submission, the question here says, do crunch automatically make these submissions for director's salary? So I think the answer to that is, in general, the crunch system can make the SBS for you.
Yes, but it needs to be authorized.
Yeah, but you need to approve it.
Yeah.
So it will get. It rather depends on the level that your salary has been set up. We should have emailed anyone who is taking a director's salary about how it works.
Yeah.
If anyone is unclear on whether their FBS has been made, I suggest they get in touch with their client managers and they can explain how it works in the crunch system. I have dividends coming from the stock market. In calculating how much dividend I should take from my limited company, should I wait before creating dividend vouchers for this tax year? So
if they know how much they are getting from, let's say, the stock market, then they could obviously factor that in when they are doing, let's say, their calculation for drawing dividends out of their company.
Yeah.
If they don't know, that is when it gets a bit more difficult.
Yeah.
But
dividends are a use it or lose it tax break. So you do want to make sure that you take as much dividends as your company can pay you efficiently in each tax year.
It also depends on when the dividends will be paid as well. So if the client knows, let's say, they usually get it around maybe the end of March or whenever, then they could obviously wait till then, figure out what the amount is, then they can then take the rest from their limited company.
But you definitely want to make sure that in this tax year you take as many tax-efficient dividends as you can, otherwise you lose that benefit.
Yes.
If anyone needs individual advice and they're a crunch client, then just speak to their client managers. We can help you with all of those things. There are more questions, but I'm conscious we've run 25 minutes over time already. So what we will do is, where the questions are about someone's individual situation, we will try to get back to them individually. Where the questions are sort of a more general question, we will publish the questions and obviously anonymized, but we will publish the questions and then give our general answers on the knowledge article about end of tax year. So within the next few days, we'll have answers to the questions and this recording of the video up on the knowledge article, and we'll also send out links to people over the next few days once they're ready. So I'd just like to say thank you very much from Michael for his time today. And thank you to everyone who's attended, and good luck to everyone, and stay safe with this coronavirus that's around. Thank you, Michael.
Thank you.